Hello everyone! Today we are doing a deep dive on a company that I believe is one of the most powerful yet overlooked monopolies in the American economy, Intuit. We'll go over their business, the key highlights of their operating metrics, as well as check out their score on my monopolistic score, which is available for everyone to check out. After that, we'll take a look at the valuation to see how it stacks up now. So let's start. The business. Intuit is a company which makes software for SMEs or small and medium enterprises, and that software is mission critical for them. Why? Well, there is no question about it, as everyone must pay their taxes and keep track of expenses. You can see also their other functions that they give to their customers. Intuit created a software called QuickBooks exactly for that. Accountants now have an easier way to monitor the situation of the companies that they are in. Intuit also has the biggest market share of any other competitor. They have around 60 to 80% market share in the US accounting software market. But if you think that they only do accounting, you'd be wrong. They are much more diverse than that, as you can see from this infographic. For example, they do TurboTax software, which makes filing out your taxes easy and simple. You can either get it filled in yourself with the help of a person, or let someone else take care of it completely for you. If we go on to their key business highlights, we see an interesting picture. A dominant player in the industry, which isn't too leveraged, as you can see from this infographic. Cash minus debt, resulting in around 900 million in negative cash, and also a strong revenue growth track record, as you can see here. Look at this. This is 15% on a year-over-year basis. You can see this. Basically phenomenal. I like that. When a company is growing their top line that fast, it's a good sign, because all of that free cash flow has to support their shareholders. And one of the ways they do it is by using dividends and share buybacks. And I'm a huge advocate of companies which do that. Also, the dividend is growing at something like 15% per year, so great. What's even better is that this is a high margin business, with most of their operations software based. As you can see here, gross margins 80%, operating 25%, and 19% net profit margins. Why? Well, this is a web application. That's why I chose it, as it's a software company and those usually grow the fastest. Usually, of course, because, it depends. Here, you can see how their business metrics look. And, it is visualized in this dashboard here, which I built myself, and you can access it via a paid subscription on my Substack. And you can see here that it's growing at double digits. Look at this. Total shareholder returns on a 5-year basis, 22%. Their online ecosystem revenue grew 20%. That's great, We can see that they're growing at double digits, which is something that is expected from a small-scale startup, but not a billion-dollar company. Intuit is proof that you can grow quickly as a big one. 20% growth is a highlight. It's just phenomenal. Okay, so we know what their business is like and what the most important financial metrics are here. What about their moat? Do they have one? Well, as it is, I built my very own algorithm for analyzing that. You can say it's like FICO, but for analyzing company moats. It takes those 5 metrics and creates a score out of them. And you can see that it's the free cash flow margin, revenue growth versus the industry, and some others. And I will quickly go over each and say my opinion on it. You can see that they are great in their margins. 80% is something to like, as it's essential towards building those shareholder returns, dividends and buybacks. While their ROIC isn't at its absolute best, it isn't bad. There's room for improvement. It shows a moderate take on their returns on invested money. The R&D score is also very important for any business. We all know that too much R&D can be as bad, if not worse, than no R&D. Capital needs to be allocated smartly, and Intuit is a prime example of that, with their 15.68% revenue backed into R&D. They deserve a 10 out of 10 for that, because it's in the just right category. Not too much, not too little. Their free cash flow margin is also great, scoring 9 out of 10 with minimal negative pressure. On the revenue growth part, we can see that they're beating their peers only by a little bit, by 1.95%, against the weighted average revenue growth rate, which doesn't necessarily mean it's bad, of course. It's just a sign of keeping up with the industry, which would signal some overall industry slowdown. Overall, the tier score of 7.4 out of 10 demonstrates that they are a high-quality company with some small areas of improvement, mainly in their revenue growth and ROIC. Now, let's continue on to the valuation, of course. A standard 5-year discounted cash flow model, like the one on the left, suggests the stock is slightly overvalued today. And if you believe Intuit's growth will slow down, then that is a fair conclusion. However, I believe that this model is far too short-sighted. Intuit's own management, with a strong record of meeting its targets, is guiding for 15 to 20% long-term annual growth. If we build a model that reflects a little below this guidance, using a 10-year forecast, you can see on the right that the valuation becomes much more compelling, with estimates reaching over 1,300 per share. And this is based on a revenue growth rate of 10%. My investment thesis is based on the belief that management can achieve this long-term guidance, as well as keeping their monopolistic position in the market. So what is my final verdict? The monopolistic score proves this is an elite 7.4 out of 10 company. While the stock is not cheap by any traditional short-term metric, my buy rating is based on a conviction in the long-term durability of its moat, and the company's ability to meet its stated growth targets of 15 to 20% over the next decade, but 10% will still be sufficient. This is an investment for those with a multi-year time horizon, who believe, as I do, that the market is underestimating just how long this company can continue to grow. Intuit's core business of making taxes and accounting easier is not going away, and its dominant market position makes it a prime candidate for long-term growth. Thank you guys for watching. Stay focused on the fundamentals.